What's going on, guys? One of the most important phases of home ownership is finding the lender, finding the realtor, and then the house hunting phase. What's going on, guys? My name is Minh with What's a Mortgage. Tonight, we are going to go over phase 3 of the 5 phases of home ownership, which is the house hunting phase. Finding your home, right? Finding that house. So important that we follow these steps through these phases so we can find home ownership a lot quicker. All right, guys, if it's your first time tuning into my live stream, my name is Minh. Welcome, welcome, welcome. The goal of our live stream is to educate, empower, and to connect you with the right mortgage. If it's your first time tuning in, turn on your notifications so you're notified every time we go live or post new content. We post new content every day, but Mondays and Wednesdays, we go live at 9 p.m. on Facebook, Tuesdays and Thursdays, 9 p.m. on Instagram. All right, guys, hopefully you're having a great night. Let's get into it. So before we talk about the phases of home ownership, we're gonna go over the 5 checkpoints, right? After we go through the 5 checkpoints, we're gonna go over selling market versus buyer's market, okay? The different types of listings, purchase contract dates, what is escrow, opening escrow, and beginning escrow. What is the difference? And last but not least, your EMD check, your earnest money deposit check. All right, so let's get into it. The 5 checkpoints, okay? So now that you found your lender and now that you found your realtor, the next step is shopping for a home. When you're finding a home, each week you go out, you must check the 5 checkpoints, okay? You gotta check the credit report, the income, the deposit, the pre-approval letter, right? The interest rate. So let's talk about this credit report. This is where everyone wrestles with the most, the credit report. Your credit report is good for 90 to 120 days. So happens all the time. People go out, they get pre-approved to buy a house, but they don't pay attention to their credit report. And then as long as they find a house within 90 days, they're fine. But if they find a home in about 90, 91 days, and they get all excited, and all of a sudden, the lender wants to run their credit again, and the credit score drops. What happened in between that time? After people get approved for home ownership, I see the big mistake that they all do. They go out and they start getting approved for other things. They think they're at the end of the race, and then they're not. Right now, it's taking longer to find a home. Of course, when it's a seller's market and it takes a long time, right? That credit report can expire. So each week, as you're out there looking for a home, I want you to pay attention to how old is your credit report. As you're finding a home, how old is that credit report? If it's getting to that 90 to 120 days, you might want to have your lender run it again. Make sure the FICO did not drop. As you're shopping for a home, do not go out there because you think you're at the end of the race because you got approved for your mortgage and start getting your credit ran by other creditors, other lenders. So if you're gonna shop your mortgage, make sure you give your credit score to other lenders. Do not let them run your credit. When you are satisfied with the lender you want to use, if you are changing lender, then let that other lender run it one more time. But do not let multiple lenders run it. And when you stay with the original lender, which happens a lot, and when they run it, all these inquiries pop up and the FICO drops. You can either get a higher rate or not qualify at all. So make sure that credit report, you pay attention to that date when it's getting close to that 90 to 120 days, that you make sure you have your lender run it again, okay? Next one is your income. If you are self-employed, you want to check your deposits. You want to make sure that your deposits are ascending and not descending. Especially if you're buying a house right now during a pandemic and you're self-employed, they want to make sure you're getting deposits and that your deposits are averaged out over the last 24 months and it really hasn't seen a dip. If there was a dip, they want to make sure it's picked up again before they go and loan you money. So make sure if you're self-employed, that if you really want to pay attention to your deposits. because your deposit is your source of income if you're self-employed. So if you're buying a house and you're self-employed, once you check your credit, you want to make sure you check your deposits. If you're a wage earner, you want to check your income. If they used overtime or bonus, any other source of income to qualify you as your wage earner, you want to make sure that income is ascending, is not descending, right? Especially if a job requires a lot of overtime and they used overtime to qualify you and you don't have that overtime anymore, it can knock you off from getting approved. This happens all the time. We went through a scenario last week. A borrower got approved for a loan, and while they were shopping, the husband's employer cut back their overtime. And now that they're in escrow and the lender orders an updated VOE, the income is declining. Because it's declining, they don't qualify for the property anymore. Even though they had savings that they can afford the payment and weather the storm, the lender doesn't see that consistency that they use to qualify with that overtime. So if they used overtime, they use bonus, or if you work 40 hours a week and now you're not working 40 hours a week, guess what? It can knock you out from getting approved for home ownership. So you want to make sure they check that credit. You check that income every week as you go out there shopping for a home, right? Log into your bank account, see your deposits. If you have a payroll deposit, check the overtime, check the bonus, right? Make sure it's ascending and not descending, right? Next, check your deposits. If you're using a bank account and that bank account has large deposits that are not payroll deposits, the lender's going to want to source it. So every week as you go out there, even though that bank statement hasn't come out yet, you want to log into a 30-day transaction on your account online. And if there's a big deposit, start sourcing it. Start giving letters to your lender. Hey, this is this deposit. This is that deposit. If it's cash and you can't source it, you might have to back out that deposit. What does it mean by backing out that deposit? For example, if you have $10,000 in your bank account and you have $5,000 in cash that you cannot source, then you only have $5,000 in your bank account. So you want to make sure if you can't source it and you back it out, that you still have enough money for the down payment and closing costs. The down payment and closing cost was $10,000 and there's $5,000 you can't explain. You only have $5,000. Now you have to go out and get a gift for $5,000. So check your deposits every week, okay? Fourth thing, check your pre-approval letter. Remember, if you go out there and you write offers, make sure your approval letter holds up to that offer. If you got approved for $600,000, you see something for $610,000, you want to make sure you get that updated approval letter. What I would do is I would look at my approval letter, and then I would look at the houses I'm writing offers on. If it goes above my offer letter, I want to go back to my lender, have my lender update my approval letter, right? You should do this each time you go out and look for a property. If the property you're looking at is under your approval letter, you're fine. But if it's over, you want that updated approval letter. The last thing you want to do is fall in love with the house. You can't get a hold of your lender because it's the weekend. And all of a sudden, you cannot write an offer on that property, right? So you want to make sure you check that approval letter. And last but not least, check interest rates. If the lender gave you a specific interest rate and rates have gone up, you qualify for less home. If rates have gone down, you might be able to get a lender credit for closing costs. You can change your budget around. So definitely make sure you check rates each week as you go out and look for a home. What happens? You fall in love with the house, you write the offer and rates have gone up and now you can't afford that home, right? Or you can afford it, but now you're not happy with the payment. It's hard to love the payment if you don't pay attention to the rates. So before you go shopping for homes, you want to make sure you check the 5 checkpoints, okay? Let me say them out loud for you again, right? It's check your credit report, check your income. If you're self-employed, check the deposits. If you're a wage earner, check your pay stubs, okay? Check your deposits each week. Do you have to source a big deposit? If you can't source it, you back it out. Do you still have enough money to buy? All right, and then so fourth one, check your approval letter. Make sure when you're out there looking for the home is less, right, than your approval letter. If it's more, get that letter updated. And of course, the fifth thing, check your rates. Know what the payment's at, right, on the purchase you're buying, right? Know if rates are going to go up, is your payment going to go up, or rates are going down? Do you still qualify? So as you're going through the home finding phase, you want to check these 5 checkpoints each and every week. Where do I get the 5 checkpoints? It's in our Ultimate Mortgage Guide. If you go to whatsamortgage.com, you can download our Ultimate Mortgage Guide and make sure you check these 5 checkpoints every week as you're out there shopping for a home. The last thing you want to happen is have expired credit, declining income, deposits you can't explain, pre-approval letters that are under what the home is worth, and a rate you can't afford the payment. All right. So once you check the 5 checkpoints, the next thing is realize and understand what type of market are you in, right? Are you in a seller's market or are you in a buyer's market, right? Ask yourself that. What market are you in, right? So a seller's market. Okay, let's go over the seller's market, right? In the seller's market, when demand is high and there's not enough inventory. If you're watching this video in October 2020, it's definitely a seller's market, right? Here are the signs, right? In a seller's market, there's not enough inventory. You're not going to get closing costs. A lot of people who are doing down payment assistance, right? They can't get the closing costs from the seller, and now they got to come out of pocket. When you're doing down payment assistance, you will come out of pocket between 2%, 1.5% to 2%. If you got to come out of pocket 3%, you might want to consider going FHA or conventional before you do down payment assistance, okay? So in a seller's market, you're not going to get closing costs. So you might want to take some step back, have the lender send you a loan estimate so you can see what closing costs are. In a seller's market, you're not going to get too much help, okay? Also, what's going on right now? The homes might not appraise, okay? So the home might not appraise in a seller's market. If the home doesn't appraise, well, if the home doesn't appraise, the seller is going to sell it to me for a cheaper price. That's not going to happen. In a seller's market, if you don't buy it because it didn't appraise, they might have backup offers that will pay cash or pay the difference. Don't think if the home doesn't appraise, the seller is going to back off. But in a seller's market, there's a high chance. Here's a little quick tip for you. If the home doesn't appraise and you still want the house, you might want to look into a renovation loan. Okay, FHA has one, VA has one, and conventional has one. You can get a VA mortgage. You can get a VA, FHA, or a conventional, and a renovation loan. They will finance up to 110% of the appraised value. And that's going to help you out tremendously, especially if you're short. If you're short on funds, you'll get that money to help you buy the house. You still got to come in with your down payment, right? On FHA, 3.5%. On conventional, between 3 to 5%. On VA, it's 100% financing. It can't get better than that. All right. So now we know in a seller's market, not enough inventory, lack of closing costs, the home might not appraise, right? And letting the sellers live in the house longer than expected. I know it's a dream killer, but it's real, right? In a seller's market, remember, if you find a property, doesn't mean the seller found a property, right? You want to make sure you're patient and you allow the seller to find a property. If you want to buy the house, sometimes once you close, then they can close. Well, they can't close until they get the money from you. So sometimes once they get the money from you, it might take them longer to close. And this is what you want to negotiate up front. Right? Of course, like I want the house. As soon as I close it, it's mine house. That might be a deal breaker with the seller. You might lose the chance to get the home because you're not willing to let the seller live in the house longer. Because don't forget, they got to find a house too. And they can't close escrow. Let's say they're in escrow. They can't close until your loan funds and then they get the funds and then they can close. All right. So make sure in a seller's market, patience, Daniel son. Patience, grasshopper. If you want the house, you got to be open-minded, okay? Also in a seller's market, you're dealing with a bidding war, right? Multiple people writing offers, driving up prices. Of course, you're going to hit a certain dollar amount where everyone backs off. So in a seller's market, remember, there's a bidding war you got to deal with. So in the home finding phase, if it's a seller's market, there's a lot you're going to have to deal with, right? You're not in control. So you need to make a list of things that are negotiable and non-negotiable. In a bidding war, of course, you have a max purchase price you can go up to, right? A max loan amount because you have a max DTI, or you don't have the cash to come in with the difference if the home doesn't appraise. A lot of times, if the home doesn't appraise, right, in a buyer's market, which is different, then you just have to come, then they will bring down the price. But in a bidding war, if you don't buy it, someone else might. So remember, be open to understanding that. I think if you're buying a house in the home buying phase, you found your lender, you found your realtor, and it's a seller's market, you need to be more open-minded, right? Bidding war, multiple offers, right? You have a seller sitting there with multiple offers. Which offer should they pick? And this is why it's really important to work with a great realtor who knows how to write a letter and also control the seller's expectation. Sometimes with multiple offer, the highest purchase price might not win. What the seller agent goal is to protect the seller, right? Ooh, protect me, right? They're there to protect the seller. So they want, of course, the best offer with the most conveniency for the seller. So when you're dealing with multiple offers, make sure as you're in the home buying phase that your offer sticks out like a sore thumb in a seller's market. And one last thing in a seller's market, buy as is, right? So when you're buying the property, well, this is broken, that's broken. Well, I'm not buying it until they fix that. Remember, there's a bidding war, multiple offers. You're going to say buy as is. And if you don't fix it, someone else will buy and not ask for it to get fixed. In a seller's market, you need to be flexible. So now that you have your lender, you have your agent as you're out shopping, right? If you're doing an FHA loan, make sure it follows under FHA guidelines, VA loans under VA guidelines, conventional under conventional guidelines, okay? When it comes to buying as is, make sure that when they do the appraisal and the home inspection, it falls under the guideline of the program you're getting, the type of loan you're getting, okay? So make sure you understand what you're dealing with in a seller's market, okay? The reason why I want to explain that is for you to have a deep understanding. As you're out there buying in a seller's market, you're not the only one who's buying. Remember that. I think that's one key factor most buyers forget, that in a selling market, they don't have that control that they would in a buyer's market. Oh, I'll just wait for a buyer's market. Well, if you wait for a buyer's market, we don't know when that's going to come. If you're going to wait for a buyer's market, we don't know what's on the other side, right? So, of course, all I can do is explain to you the type of market. Hopefully, when you go out there and you buy, you understand, oh, I'm in a seller's market or I'm in a buyer's market. And then you just adjust your mindset and and then your train of thought, right? Managing expectation, okay? So a buyer's market, low demand, too much inventory, ask for closing costs, right? Getting undervalued valuations, controlling the terms, the lack of offers, right? And discounts and repairs. So of course, in a buyer's market, you have more control. We don't know the next time we're gonna be in a buyer's market, right? Well, it's gonna happen sooner than later. People are leaving California. People who are leaving California, majority of them were not homeowners. Okay, people who are homeowners, of course, there is a percentage leaving, but the percentage is like this compared to people who are staying. Okay, but if you do fall into a buyer's market, right, you have low demand. Now you have more control, right? If there's a lot of inventory, you have a pick of the litter. Remember that. If you're in a buyer's market, if you decide to leave California and go into another state, right, there might be a buyer's market. Okay, if you're seeing a buyer's market, you'll see low demand, you'll see too much inventory. Now you can ask for closing costs. If you're asking for closing costs, what I would do is I would come in with if you have good credit, I would go conventional, come in with the minimal down, ask the seller to cover closing costs. If there's enough room budgeted, cover your MIP. Instead of putting 20% down, you can put 5% down, 3% down, 10% down, 15% down, and ask the seller to cover the costs. So everyone likes a buyer's market, right? So if you want a buyer's market, you might need to leave California for that, okay? But they are out there. Where? I don't know, but if you start seeing low inventory, right? I mean, high inventory, low demand, you start thinking about cover my closing costs. You have to come out of pocket with the minimal down for your down payment. But you could ask the seller to cover closing costs, maybe buy your PMI. That would help out a lot, okay? getting undervalued evaluations, right? So when they go out there and they give you an evaluation, the home might not appraise, it might come in less, and you're like, woo! If it comes in less, right? They either can sell to you as is, you might have to come in with the difference, but in a buyer's market, they're gonna back off the purchase price, right? Which means you get a cheaper mortgage payment. So in a buyer's market, the home might not appraise. In a seller market, if it doesn't appraise, you gotta come in with a difference. In a buyer's market, if the home doesn't appraise, you just hit the jackpot, okay? Also, in a buyer's market, you control the terms, when you want people to leave, when you want to move in, when you want to close. In a buyer's market, you have full control. Control. I don't know, you guys might be too young. Remember that Janet Jackson song? Control, right? So you have more control in a buyer's market, right? You set the terms. Because of the lack of offers, right? The world is your oyster. Also, in a buyer's market, there's something wrong with the property. Guess what? You can get them to fix it, right? You can get them to fix it. Remember, these people are desperate to sell. So when you start seeing these conditions pop up, right? Low market, right? Too much inventory, homes underevaluated, right? Lack of offers, discount for repairs. Now you're in the buyer's market. You're in the driver's seat and you could have choices. Remember, if you pick an area that's a seller's market, you know how to deal with it. Now, if you get into an area which is a buyer's market, you know how to control that, right? The main thing is to know the type of market you're in so you can control it. The next thing, now that you picked your realtor, you picked your lender, you pick your realtor, you have the 5 checkpoints to check every week to make sure that you close smoothly, okay? Now you know it's a seller's market or buyer's market. The next step is, when you're out there looking for property, what are the type of listings there are out there, right? What type of listings are they out there? Are there short sales, auctions, REO, probate, right? Bankruptcies, FSBOs, and traditional, okay? So let's get into that. So short sales. So a short sale is a pre-foreclosure. A short sale is when a consumer can't afford their mortgage payment and the balance is worth more than the home is worth, right? Then they have to short sell it, right? They have to short sell it for less than the balance owed, right? In a short sale, this is what people get confused. There is an approved short sale and there's a non-approved short sale. In a non-approved short sale, you write offers, okay? In an approved short sale, the bank has already approved the price. So if you owe more than the house is worth, what they say right now, if you're watching this in October 2020, right? 9% of people in mortgage forbearance are underwater. 9%, right? I think it's like 306,000 homes in the United States. Sounds like a big number, but in the United States, that's not a huge number. So if they can't afford their mortgage, right, they have a chance to sell it as a short sale before it's foreclosed. So when you're out there trying to find a property to purchase, most likely you guys are digging for short sales. Are they easy to find? Heck no. In a seller's market, someone's going to come in and gobble up that property. If it's upside down, right, you might have a chance. You're not going to get some insane discount because it's a seller's market. In a buyer's market, you might have a chance. In a seller's market, no way, right? Because they already owe more than the house is worth. They're already taking a loss. They're not trying to take another loss. So when you write an offer for a short sale, there's something called a BPO, broker price opinion, right? So when you want to write an offer for a short sale, the bank sends out a realtor, a broker, to give it a look, right? How much is that home worth? They give their broker price opinion. Once they give their broker price opinion, right, that's when the bank analyzes it and says, hey, I saw the broker price opinion. Yes, I think the price is right. If you want to buy the house, you got to buy it at this price, right? If they look at, oh, I can tell the real estate broker underpriced it because maybe they're trying to get that house themselves, the bank's going to go, heck no, we know it's worth more than that. We already took a big loss. We want this price instead. So when you write an offer for a short sale, they're going to do a broker price opinion to see if they want to take that offer. So don't think because it's going to foreclosure, it's a short sale, that you're going to get some smoking deal, right? You just got to still deal with the bank. So remember, when you're dealing with a short sale pre-foreclosure, it doesn't mean you're going to be guaranteed a great deal. You get to write an offer on a house. They're going to do a broker price opinion. They're going to review your income, review your paperwork, review the seller's income paperwork to make sure they don't qualify for a mod, and then offer to sell you the house. Right? Once they offer to sell you the house, it's called an approved short sale. Once it's approved, you got to close in a couple weeks, right? So when you write an offer, let's say you do a 60, 90-day escrow, when they finally approve your short sale, you might have 2 weeks. That's why if you're buying a short sale, you're working with a real estate agent and a lender, right? And make sure that lender gets you that underwritten approval. Even though you haven't gotten your short sale approval yet, you want to start clearing your conditions. So when they approve that short sale, you're ready to close ASAP. Okay. The last thing you want is if you can't close on time, there's no extensions when it comes to short sale, right? You would have to start the process all over again. And if the seller misses too many payments and you're getting deep in and you haven't closed, they might foreclose on the house and you lose your chance of buying that short sale. If they foreclose on the house, right, you are buying it at auction. Say it with me, guys. Auction, right? So when you're buying at auction, it's been foreclosed. You're not getting finance for it anymore. You got to pay cash, right? You got to pay cash. You're going to compete with other investors. If you go to the county courthouse right now and you're trying to buy an auction property, you won't see a lot of people there because there's not a lot of homes that have been foreclosed on. Before the pandemic, there wasn't that many foreclosures, right? Right now, there's a lot of forbearances, but out of all the forbearances, we don't know what's real and what's not real, right? So, but they said only 9% of the forbearance is upside down. So 300 and something thousand houses in the United States are underwater. So those houses, of course, if no one buys it at short sale, that means someone didn't get to it before you did, right? Another thing is sometimes banks will call their hedge funds. If they went through no one buying a short sale, hedge funds not buying, and it hit the market, something must be really wrong with the property. If you're buying at auction, you got to make sure you have that cash. Because if they can't get financing from a short sale person buying it and the hedge fund's not willing to buy it and fix it up, this is where you come in as an investor. You pay cash and you might get a discount on the property, but there might be other liens on there. The property might not be functional. That's why it couldn't go through a short sale. A lot of things can happen, but at auction, you got to be ready to pay cash and you got to make sure that the juice is worth the squeeze for you to buy at an auction and do the repairs to make sure the house brings value, right? Or it has value. So short sale, you buy it, it's pre-foreclosure, you buy it when they're missing payments, but they owe more than the house is worth, okay? And of course, there's a approved short sale and there's not approved short sale. Of course, a not approved short sale is when the bank hasn't approved it. You got to write an offer, they do a BPO, and if they accept it or they change it, you go back and forth with the bank on terms, and then you finally agree on the terms, then the short sale gets approved, right? Then you can buy that route. But if for some reason you can't close or that property sits too long, right, it goes into foreclosure, then it gets sold at auction, right? So now you're done with auction. If they don't buy it at auction, right? I did it in steps. You say, right? It goes to REO, bank-owned property. So if they can't sell it at short sale, and they can't sell to the hedge funds, and they can't sell it to auction, then it makes it to REO, bank-owned. So when you're looking online and you see REO, that means not enough people did not want the property. Of course, in the crash of 07, 08, and so many properties were getting foreclosed on, that's why you saw so many REO properties hit the market. They just couldn't handle the amount of homes they were getting foreclosed on, right? That couldn't sell at short sale, didn't sell at auction. There were just too many properties. So of course, at that point, they became REO. Now, if you want to buy REO, you're buying from the bank, but the transaction moves a lot faster than a short sale. Okay, so when the bank takes hold of the property, right, they get the consumer, the seller, out of the house. They do cash for keys. They upkeep the property, and then they sell it. They use asset managers who either represent the bank or they're just a third-party company, and then they assign it to a real estate agent to cash for keys, to update the house, and then sell the house. And of course, they make listing commission, okay? So when you're buying REO, It's like buying traditional, but you're buying it from the bank. You can get it like that. It's not like a short sale where you have to get approved, okay? So if you find a bank-owned REO right now, why is it an REO? Most likely, if it's bank-owned, you're probably paying cash for that property, okay? So that goes over, hopefully that explains the buying foreclosure method to you, right? Buying auction, bank-owned properties. So you know now when you're out there, you're in that home finding phase that if you see a short sale, what do? Right? If you're going to buy at auction, you know what to do. If it's an REO and bank already took a hold of the property, now you know what to do. The next one type of listing is probate and bankruptcy. Of course, if someone passes away and they didn't bequeath, which means they didn't assign the property to somebody, right? The home goes into probate sale. Of course, if you're an heir, but they didn't bequeath the property to you, you can still go out and get the property through probate. But if there's no one they can assign the property to, it goes to probate. When it goes on the market, right? The trustee puts it on the market, goes up for sale, right? The property goes up for sale. When you write an offer on the property, right? Or if you know about a probate, you write an offer on it. Once you write an offer on it, they increase it by 5% and they put it on the market. That's what the court does, right? They put that property on the market. Remember, if you're buying probate or bank owned, you're probably gonna have to put 10% down. That's non-refundable. Of course, if someone else buys the property or you buy the property, it goes towards your down payment. If you don't buy the property and someone else buys it, you get the money back. But if no one buys it, you lose your 10% deposit. So whatever you buy the property at, right? Whatever you offer, if you're the first person that offers on the probate or the bankruptcy property, then the judge increases it by 5% and puts it back on the market. Okay. If there's other offers, once there's other offers, you go to court and that's when you bid for the property. Okay. If the property if you wrote an offer 6 months later, the value comes in higher and they increase it by 5%, right? You could be getting a deal because they increased so much, but they only can raise the price 5% of what you offered. Okay. Let me explain again. You offer something on a probate or a bankruptcy property. The court takes what you put out there and increases by 5%, and it opens up to the open market. The open market, anyone can bid on the property. They can show up for court and bid against you. Of course, if no one shows up, you get the property, okay? But if someone shows up, now you're dealing with bidding against them. You can get financing for it. You want to make sure you do all that financing up front, okay? But of course, you got to have that 10% down. That goes towards your down payment, or your down payment, your closing costs if you're buying with under 10% down, okay? So probate, someone passes away, that person didn't give it to any heirs or any relatives or any heirs, right? So now it goes to probate. If a relative wants it, it will go to probate. I've seen people, oh, it was in my family, but you're not an heir, like a son or a daughter. You're gonna have to deal with the public as well. Okay. Same thing with bankruptcies. There's bankruptcy lawyers. It goes through the same process. It's just people file Chapter 7 and it's time to get rid of the house and pay off all the debtors. Okay. Next one, FSBOs. This is where people wrestle with. Okay. These for sale by owners. Is it a good thing? I think when you're dealing with a FSBO, they're pretty frugal people that want to keep all their money. The thing I run into the most about FSBOs, all FSBO sellers think their house is worth more than what it's actually worth, right? They're trying to squeeze you. They don't have all legal representation. A lot of FSBOs will pay a buyer's agent. That I think is a good thing because you have someone who's experiencing representing you, but they're representing themselves. When you're dealing with these FSBOs, they think their home is worth more than what it is. You're really haggling back and forth. If you have the patience, you get to where you want to be. But a lot of buyers agents and buyers back off when they see it's a FSBO because they're going to deal with somebody who is not reasonable, okay? So when you're dealing with a FSBO, make sure, hey, is this person cuckoo, right? Or are they reasonable? If they are, you can still deal with them. But if they're not, you can go back and forth for months and nothing can happen, or they can cancel at any time. So when you're dealing with FSBOs, you got to be very patient and you got to sniff it out, right? Is this person crazy? Are you crazy? Or are you not crazy, right? Last but not least, traditional sale. So in a traditional sale, someone is selling the house because they're an investor, or they're selling a house because they're not in trouble. They're just selling the house. And if you're dealing with traditional, you're dealing with the seller's agent, right? You're dealing with the seller. Right now, of course, there's more traditional sales than there are short sale, auction, REO, probate, bankruptcies, and FSBOs, right? So when you're dealing with traditional, make sure you have representation. Make sure you have your financing ready, right? You can finance. The homes have to appraise. If you're getting a mortgage, if not, you can pay cash. If it doesn't appraise. In a traditional, pretty much the game is who can be patient and who can be patient enough to see things through. In a traditional sale, you got to write a lot of offers in a seller's market, okay? You need the patience, right? When you're dealing with short sale, you're dealing with the bank, right? When you're dealing with auction, you're dealing with the court. REO, you're dealing with the bank again. Probate, you're dealing with courts. Bankruptcy, you're dealing with courts. FSBO, people might be crazy. In traditional, there's a patience that comes with it. And there's different types of patience because, see, short sales, they're more institutions, except for FSBO, you're dealing with. In traditional, there's a certain patience. The reason why there's a certain amount of patience, because if they want to go in your offer, don't get too excited. Be patient. No matter what, don't get too excited. Just be patient in a traditional sale. So when you're out there looking for properties, you need to know what type of listing is this? Is this a short sale, auction, REO, probate, bankruptcy, FSBO, or is it a traditional sale? If it is, okay, you're dealing with patience with someone who's human. They might have to sell an upgrade. There's a lot that goes to it. When you're doing short sales, auction, REO, it's very much plus and minuses, right? This is what you get, this is what you expect. You need to have that patience if you're going to buy a home and it's a traditional listing, okay? Now we know the different types of listings, right? The next one is purchase contract. Okay, when you're dealing with finding a property, once you found one, like, I found a listing. Finally writing an offer on a property, right? The next step is the purchase contract. When you're dealing with the purchase contract, once you find your property in the finding phase, right? You want to look at the home inspection contingency, the loan contingency, the appraisal contingency, and the close of escrow date, right? So this home inspection, right? There's a difference between home inspection and appraisal. The home inspection is there for you to make sure the house is functional. So if there's something wrong with the house, you want to negotiate once you do the home inspection, right? You have 10 days. So when you sign that purchase contract, the day you sign, you have 10 days to inspect the property. If there's something wrong, you want to address it right then and there. Doesn't mean they're going to fix it, but you have 10 days to just back out. Oh, no, there's something wrong. Back out. Get your deposit back, okay? Once the home inspection is done, then there's the loan contingency. Of course, when you write an offer and it's a seller's market right now, you want to do no loan contingency. The best way to do a no loan contingency, make sure you're dealing with a lender that's giving you an underwritten approval. If it's been the income, the asset, the credit, everything's been validated by the underwriter, you might not need a loan contingency. That right there gives a seller more confident that you can close, okay? But if you feel iffy, you have that loan contingency. So if the home, next one, appraisal doesn't appraise, right? But the loan can't get done, you can get your deposit back. But if you release your loan contingency and appraisal one, you're pretty much gonna lose your deposit, okay? So when you're looking at your purchase contract, once you find the home, you wanna make sure the home inspection, right? You pay attention to that date, the loan contingency, that appraisal, and the close of escrow date, right? You want to make sure you check your timeline and you follow suit to make sure you close on time. The last thing you want to deal with is an unhappy seller in a seller's market. You want to manage your expectation, manage your landlord's expectation, manage your employer's expectation. When you're buying a house, you might need time off, right? You buy a house, there's so many people involved that you want to make sure you pay attention to these 4 dates when it comes to the purchase contract, right? Those aren't concrete dates, so you can make the inspection sooner or later. You just need to know how to negotiate with the seller, right? Especially if you know the seller might need to live in the property longer, you might be able to increase the dates, okay? So it's really important you work with a great buyer's agent so you can be patient. Like I said, traditional, it's not like buying from the court where like these are mandates. When you're buying traditional, you're dealing patiently with a human that you might be able to maneuver around some of the dates as long as you understand them and you're patient. Okay, so in a seller's market, you want to make sure you check the dates on your purchase contract. Find out when the seller's gonna need to move out. Of course, if they're overseas, they're out of the state, they might not care, right? But if they have a specific timeline because they need that equity to move on to something else, you want to make sure you're careful on those dates. Okay, so now that we do the 5 checkpoints, we know it's a seller's market or a buyer's market. Okay, you know the different types of listings. You understand the dates on the purchase contract. The next thing is, once you find that house, right? You drove for weeks, for days. You wrote tons of purchase contracts. You reviewed tons of dates on the purchase contract. You saw an REO, a bank owned, right? All these listings. What's next? Well, what's escrow, right? People ask me that question all the time. What is escrow? Escrow is a third-party neutral company that the seller picks. Okay, keep in mind, the job of the seller is to be on the escrow is to be honest and fair, right? Once the seller picks them, right, then their job is to make sure that title gets what they want, the seller gets what they want, the buyer gets what they want, and if you finance it, the lender gets what they want, right? So they're there to make sure no money exchanges hands, nothing happens until everybody completes what they're supposed to in the transaction. Okay, so when you're buying a property and you're in escrow, which means you selected a third-party company to let the transaction begin, to make sure, right, like a referee, everyone stays honest, everyone commits to completing what they agree to before any money or any property changes hand. Okay, so when someone says I'm in escrow, that means there's a property, it's been picked, you're ready to rock and roll. But before any money changes hands, escrow's job is to make sure everyone does their fair share, right? What are the fees of escrow? Escrow is typically $2 or $2.25 per thousand, right? So if it's $400,000 home, take 4,000 times it by either $200. Okay, so that's how it works. And then 50% is paid by the seller, 50% of it is paid by the buyer. A lot of times when you're doing escrow, there's also flat fees of a couple $100 here and there. Definitely, if you buy a home and the seller goes with a escrow company that actually has a title company as well, there's these one rates that make escrow and title very affordable on purchases. But a lot of times sellers don't do that. So if you have a good negotiator as a buyer's agent, hey, we've already budgeted my X amount for down payment and closing costs, my buyer can't go with an expensive escrow, okay? They have all the money, and then God forbid they have to pay over, can we go with escrow? If you can, go with the escrow company that's owned by the title company so you can get more affordable title and escrow, okay? Also, when you're in escrow, of course, they're supposed to be neutral. One thing escrow does do that I don't like, not all, some of them, they lower the fees on the seller side, but they add it to the buyer side. You want to make sure you're dealing with a lender and a buyer's agent that can sniff that out. Like, whoa, why are my buyer's fees so high on escrow? If they are, typically sellers, the seller, right? They wanted to go with that realtor. That realtor, hey, we're gonna get you low fees. And how the realtor get low fees? They have a deal with the escrow company to charge a lot of their fees or some of their fees over to the buyer. So you want to make sure you can sniff that out. Hey, I need this fixed because I know these fees are too high. Okay. Also, another thing, escrow starts, escrow opens. Now that you found a home in the home finding phase, right? Escrow starts the moment you sign the purchase contract. I've said this so many times right now, right? But it starts once you sign the purchase contract. And this is what happened all the time. Buyers find a house, they agree, like, oh, I love the house, and they sign the purchase contract, but they don't release the EMD check right away. They want their family members, their friends, especially if anyone who's buying, they're using a gift, the person who's gifting the money wants to see the property. You want that approval, right? So the day escrow starts is the day you sign the purchase contract. But what happens if you take 5 days, 10 days to cut the EMD check? When the EMD check is cut and cleared, the earnest money deposit check is, right, escrow opens. Okay, so escrow opens once that EMD check clears. But if it takes 10 days and you have a 30-day escrow, you got 20 days left to close. And a 45-day escrow, you got 35 days to close. So you want to make sure the day you sign the purchase contract and the day you give them your EMD check, you want to be very close to each other, right? Or on the same day even. You want to make sure that you give the lender enough time to perform. And the best way, make sure you cut that EMD check ASAP, all right? Lastly, your EMD check, right? So you found your house, you're in love with it, and you're in escrow, you started escrow, but you need escrow to open. Like I said, you need to cut that EMD check. If that EMD check is a gift, have your donor wire it directly to escrow so they don't ask for the donor's bank statement. I've seen so many people back out their EMD. Happens all the time. You fall in love with the house, you sign the purchase contract, but you need to take a step back. What bank statements did you give your lender to validate? Make sure you're using that bank statement for your EMD. A lot of times, for some reason, people don't. They cut it out of some account that their lender has never seen, and now there's all these deposits, and you can't source it on your EMD. And all of a sudden, you have to back out your EMD at funding because you can't explain the money. If you have large cash deposits, you're in trouble on your EMD, right? So make sure when you cut that EMD, you do it right the first time so you can have a smoother escrow, okay? That EMD check is to tell the seller that house is off the market, right? Also, that EMD check is there to go towards your down payment or your closing costs, depending if you're doing down payment assistance, okay? So make sure that when you start escrow that you open it by cutting them that EMD check. And you want that check to clear, and it's from an account that's verifiable that the lender has already seen. If they haven't seen it yet, do not cut that check because you want to make sure, hey, are there large deposits? That's why I have you in the 5 checkpoints, check your deposits, right? But make sure you go to the bank and use the account that the lender has validated. And that right there will save you tons of time, tons of stress, and it will protect you from closing late. All right, guys? So that right there is phase 5 or phase 3 of phase 5 of home ownership, okay? It is the 5 phases of home ownership. And today was phase 3, finding the home. Hopefully now you know how to find. We know how to find a lender. We know how to get approved. We know how to shop for your loan. We know how to interview a real estate agent, how to pick an agent. Now we know what to do as we're shopping for a home, the type of listing, seller's market, buyer's market, right? The purchase contract, what dates you want to pay attention to, what's escrow, how to escrow start, how to escrow opens, right? Your EMD check. Hopefully now you're empowered as you're looking for a home, how to manage phase 3 of home ownership, finding the home. All right, guys, if you enjoyed our content, do me a favor, hit the like button, hit the notification button so you're notified every time we go live, right? We want to end all our episode is our attitude is gratitude. Without you, there would be no us. So thank you, guys. Again, thank you so much for watching our show. If you have any challenges or concerns regarding what's a mortgage, call me 714-332-2526.